How's it going, everybody? Welcome to Fixated on Real Estate webinar with the most incredibly talented people that I know, Mr. Ken McElroy, beautiful Kathy Fettke, and the awesome and best friend of my entire life, Mr. Jay Scott. How's everybody doing today?
Wonderful.
Awesome. Great to be here.
For those of you guys joining us on this webinar, and also it's being live broadcasted through multiple channels on Facebook, we're going to be monitoring questions throughout this whole thing. We want to be able to touch base with everybody out there today and give you guys an idea of what we are all doing right now, because there's this big, huge question mark on the economy, the market. What do we do with ourselves when it comes to real estate? Do I go outside? Do I not go outside? All these things. Our tenants aren't paying rent, or are they going to pay rent? Because isn't it April 1st right now? Rent's due, Ken. Right?
It is due.
So,
I know.
Today is going to be an interesting day for a lot of landlords out there. It's going to be scary for a lot of people as well. And we wanted to be able to give you guys some advice, but also give you guys our thoughts on what's happening and some best practices. So while we're going through that, let us know. Put a comment in the webinar chats. If you're viewing us live on Zoom right now, go on the chat box, go on the Q&A box. Let us know where you're from. We want to hear a shout out. We want to hear what you're watching us from and why you're here. We're going to be doing some polls throughout this live event as well. When we get the polls, it's going to pop up and you're going to be able to answer some questions for us so we can get some feedback from you guys. Also, we're monitoring questions throughout all of this. So if you're watching this live, ask questions and we'll make sure that we get to them as best as we can. So that said, hope you guys are excited. I'm excited to have these guys. Maybe you're not excited, right? I don't know, because right now the market's so weird. So it depends on who you are. But I want to first off start by introducing some of these beautiful people. The first person is Mr. Ken McElroy. He has a lot of experience, and we're excited to have him here. So I'm going to read a little bio about him. So not too much ego there, Ken, for a second when I read this. But for over 2 decades, Ken has experienced great success in the real estate world, from investment analysis and property management and to acquisitions and property development. He's having over $1 billion in real estate. You're at what, 8,000 units right now?
Yeah,
currently?
exactly.
Mostly all that multifamily?
We have some office and some self-storage, but mostly multifamily.
He's also author of the best-selling book, The ABCs of Real Estate Investing, The Advanced Guide to Real Estate Investing, The ABCs of Property Management, and most recently his book on entrepreneurship, The Sleeping Giant. He's also the real estate advisor for Robert Kiyosaki and the Rich Dad Company, and he is an awesome, awesome dude. Loves to ski, loves to wakeboard, loves to do all that great stuff, and he's just an overall awesome gentleman. So thank you for being here, Ken. Next is the beautiful and dashing Miss Kathy Fettke, who runs this Real Wealth Network, and her husband is Rich Fettke, who's one of my favorite people in the world. Kathy Fettke is the co-CEO of the Real Estate Wealth Network and best-selling author of Retire Rich and Rentals. She is an active real estate investor, licensed real estate agent, and former mortgage broker, specializing in helping people build multi-million-dollar real estate portfolios that generate passive monthly cash flow for life. With a passion for researching real estate market cycles, Kathy is a frequent guest on CNN, CNBC, Fox, Bloomberg, NPR, CBS, basically all the TV shows out there that talk all smart like. And we love having her. So she brings a unique perspective, because she also you guys have what, 50,000 members in your guys' group that you guys help educate and also bring deals to and so forth. So awesome. Kathy, thanks for being here. And then last but not least is the incredibly handsome Mr. Jay Scott, and one of my favorite people. He is CEO and author at 123 Flip at Bigger Pockets as well. He's an author, and also you run the Bigger Pockets business podcast. You authored the book on flipping houses, the book on estimating rehab costs, the book on negotiating real estate, and a timely piece called Recession-Proof Investing. He's also a real estate investor. He has done over 400 deals since 2008, flipping, buying whole multifamily. He's touched pretty much every aspect of investing. So we are excited to have him as well. So welcome out, Mr. Jay Scott. And outside of that, we just lost our live feed on Facebook. So I'm going to restart that as we're talking as well. But while we're doing that, for those of you guys watching this, I want to say hi to some of you guys. Seattle's here. We also got Issaquah, Pete, what's up? There is almost 1,000 of you guys watching us right now, so we're excited to have you out there with each and every single one of us. So I want to take a moment and ask each of you guys, what are your guys' thoughts right now on what's going on in the market, what's happening today, and what are you guys doing, right? And so if you keep it, we're going to get a lot into this, but what do you think is going on right now? What do you want to tell people about what's happening and what you got going on in your business? And I want to first start by asking Ken, what's going on, man? What do you think? What the
Thanks.
hell's happening out there?
Well, first thing I want to just tell everybody is that we've been here before. We've had downturns before. I mean, when I first started in the business in the late 80s, we were going through a bad one. We've been through multiple ones. In 2008, our company got hit pretty hard in that one. And so a lot of the things that we're doing today are similar. It is quite different. Obviously, this is a virus, not a financial meltdown. But a lot of the things that are happening today are similar. Some are very different. So, I think that if you're a landlord or an owner or a lender or whatever you are, this is what you should be preparing for, because honestly, it's going to happen again. I don't know. The market does not continue to go up. So it's painful. I feel bad for our residents. Very bad. I think this is more of a humanitarian issue, and we're trying to work with all the people that rent from us. That's really our biggest thing. And of course, we haven't laid off any employees, which has been good. We have about 250. And, and because we're in a good cash flow position, we're not capital gain driven, we're cash flow driven. We're going to take a big, big hit on cash flow for sure. But so that's what we're doing at the moment.
So all that said, like with what are you telling your tenants right now?
Well, I think they're telling us. Today's obviously the day. When all this kind of started, they had already paid March. And, so what we've done is we've kind of rolled out an assistant program for them to be able to come in and work with us on their rent and whatever that might be, based on whatever financial hardship that might be. And I just want to point out, though, this is property management. So this is something that we're used to, not at this level, but, people come in and they have medical issues and they have job loss issues and they have all those kinds of issues. And so for us, this is obviously a lot more, but, these things were already in place. And so it's going to be a case by case basis based on need. And we're just trying to work with everybody, and we absolutely do not want to kick anyone out.
Well, we're going to get more into that too later here in the webinar about what to do as a landlord right now and some other practical steps. And we'll definitely be circling back on this topic. I want to go to Kathy next. Kathy, with you and your group, you're probably getting hit up left and right by many different people, since you guys have 45, 50,000 people in your group. What do you think's going on right now, and what are you telling and communicating to your members out there?
Well, we really have the benefit of having a lot of boots on the street teams all over the country, and we decided, it's a big country. It's all operating differently, always has been. So we're doing daily webinars with property managers in each market to tell us what's going on there. And it's been shocking to see how different each market is. Like today, we're doing a webinar with a property management company from Chicago, and most of their, I would say 80% of the people they manage are Section 8. So not really an issue. That's government money that's coming in, and the other 20% is they're going to be dealing with people who potentially have job losses. We talked to Cleveland yesterday, our Cleveland property manager there, and that's a big medical city. And she has been identifying rental properties near the medical centers, near the medical hospitals. And well, that's unfortunately a business that's growing. So she hasn't seen any change there. The day before, it was Detroit. Now that's a city that is very largely dependent on the big three auto companies, and they shut down, but many of them have continued to pay salaries anyway. And we're seeing, Ford and GM and, jumping in and creating ventilators. So kind of shifting. And then with the new CARE Act, if I don't know if it'll affect those employers, but employers will be incented by keeping people on payroll. So we may not see as many job losses as we thought if people are able to take advantage of that. So really, in summary, it's different everywhere. It's different depending on what asset class you have, and if it's ABC, or if you're, again, Section 8. So really, if that's the summary, is it really just depends, right?
Yeah, that's nobody likes to hear that. Like, it just depends.
It just depends.
Depends on where you are.
Yeah.
I remember you saying one time that the real estate market, there is no like national real estate market. It's specific to the different cities, the different locations, and it changes depending on which market you're in, right? In this nutshell. So there's hundreds of real estate markets throughout the US.
Yep.
And we'll definitely get to circle back on that for sure and talk about how this might affect different markets compared to others. I'm sure a lot of people would love to hear more about that. I know I would. So let's get to Jay. Jay, you've been around the block a little bit. And also you wrote a great book called The Recession Proof Investing. And if you guys are interested in that, look it up. And I'm sure you can tell people where it is at. But you're interviewing a lot of people on the Bigger Pockets podcast. You're hearing a lot of data right now. Like, you're hearing different perspectives. You're seeing it yourself. You're in Florida, where Airbnb is like getting decimated. What are your thoughts on what's happening right now, and what are you communicating out there?
Yeah, so I think unlike Ken and Kathy and even you, Tarl, who kind of have been really smart and have specialized in some area and kind of put most of your eggs in one basket, and that's a really good thing. I kind of do a whole lot of different things. So, I mean, a lot of people know me as the guy who flips a lot of houses, even though the last couple of years we haven't flipped a lot of houses. I do a lot in both buy and hold, lending, notes, et cetera. And I do a bunch of angel investing and business investing as well. So for me, it's kind of hit on all sides. I've been hit on the business side. I've been hit on the real estate side. And certainly what we're seeing is that there's a lot of turmoil, and unlike, as Ken said, unlike a typical downturn, we've been through those before. We've basically been through this before, but unlike a lot of those, typically we have some indication of a trajectory. We have some idea of, are we falling off a cliff? And if so, how deep is that cliff? And how long is the bottom of that cliff? And in this case, we don't really know what that trajectory is. And a lot of it's going to be driven by two things. One, it's going to be driven by how long this whole lockdown, this whole crisis lasts. And I'm sure everybody out there is reading everything from, hey, it could be done in 2 weeks. I think that's unrealistic, but people are saying that, to we could be holed up for the most part for the next 12 months. And so most likely it's somewhere in between, but exactly how long that this crisis lasts is going to play a big role on how deep the economic downturn is. And then the second piece is, what is the government going to be willing to do? And I'm sure we'll talk about that throughout this. Some people smarter than I am on this call that we'll talk about as well. But I think those two things are going to define, for the most part, how deep and how broad this next upcoming downturn might be. And I think that's going to drive ultimately what the impact is on real estate, what the impact is on business, what the impact is on the economy long term. So what am I seeing? I'm seeing a lot of people who are in wait and see mode. I'm in wait and see mode right now. Both on the business and the real estate side. I see a lot of people who are waiting for opportunities, because I think a lot of us expect that there are going to be opportunities. But I also see a lot of people who are scared, just for lack of a better term. I mean, we had, 450 properties, units under contract with some partners last month. And basically we spent 2 weeks going back and forth. What do we do? Do we move forward? Do we back out? Do we move forward? Do we back out? For anybody out there that's doing multifamily these days, I'm sure Ken will agree with this. It can be tough to find good properties. And this was a good property. Ultimately, we backed out. So I think there's a lot of what I'm seeing these days is people just kind of holding off and saying, hey, I don't know where things are going to end up. I don't necessarily want to jump into the fray unless it's an absolutely fantastic opportunity. And so a whole lot of people are just kind of sitting back and waiting and seeing.
Absolutely. And like, I think, Ken, you said the other day on a Instagram post somewhere, it's like, don't catch the falling knife. Right? So do you believe right now that it's going to be a falling knife, or?
Well, it is right now. And what I was trying to say is honestly based on experience, not based on some theory, because that happened to me. What happened to me was, we started buying in Austin, at the wrong time back in the mid 2000s. And what happened was rents went flat, concessions came up, occupancy went down. values went down, and so we had to cover it personally for a couple of years, and until they started to come back around. So that's what I was trying to say. There's a natural lag. We don't really know yet. The landlords don't know if they're going to get rent. And if they don't get rent, they don't know what's going to happen if they can't pay their mortgage. And so all that stuff, unwinds over time. It could be 30, 60, 90, 4 months, 5 months. It just depends on how much cash people have. So what I meant by that was, if, everybody's, if you're a real estate investor, you want to buy, and that's what you want to do. But my point is that I've made that mistake. I bought too early.
Interesting. Okay. So on that point, and anybody can chime in on this one, I hear what you're saying on that. And I have to say this out loud, but like, I just put a couple of houses on the market here, and I'm in the Seattle market. So it's a little different depending on where you are in the United States. But, and both of them, the two I put on last week and the one we're putting on tomorrow, I don't know about the one tomorrow, so fingers crossed, but the two we put on the market last week as flips, they sold within 24 hours. Both of them, multiple offers, both of them, and over asking, both of them. And so if I'm getting that kind of feedback from the market right now, why would I not want to keep going? Right, if that's the case.
I would sell everything if you're doing that.
So my take on that, and the kind of the analogy or the metaphor that I've been using over the last couple of weeks is, for anybody out there that grew up on Roadrunner cartoons, and remembers Wile E. Coyote kind of running after the Roadrunner and then running off a cliff, and he runs off the cliff, but he doesn't start to fall because he hasn't looked down yet. He hasn't realized he's off the cliff, and so he's kind of defying physics there for a few seconds. And it's not until he actually looks down that he starts to fall. And I kind of liken where we are right now to where he is, off that cliff, but we haven't yet looked down. So we haven't yet started to fall. And I think there are a lot of people, by virtue of the fact that they may not have been affected. Obviously, everybody's been affected, but they may not have been directly affected financially. Maybe they're working from home. Maybe they haven't tried selling any assets, or maybe they were on the market to buy a house and they still qualify to buy a house. I think there are a lot of people out there that are under this assumption that maybe the economy is going to recover, everything will be fine once this thing's over. And so they're moving forward as if nothing has changed. And at some point, people are going to, I guess, to continue the metaphor, they're going to look down and they're going to realize that we're off a cliff. And at that point, I think everything is going to stop for some period of time. Whether it's a week or a month or 5 years, nobody knows. But at some point, I think that the optimism that's still being displayed by some people in some areas and some parts of the economy is just going to stop.
Well, that makes sense to me. And it definitely, hearing what you just said, I can definitely see where your stance is on the future of the economy. I like hearing that out loud.
Short term.
Okay.
Yeah.
So we'll get back to that for sure. Like, I'd love to hear more, and I'm sure everybody else would love to hear our opinions on the short and long-term ramifications of what's happening today. Before we get into that, though, everybody that's participating in the live webinar via Zoom, I'm going to put out a poll right there. I want to get a taste of who you guys are, like what's happening right now with where you are. Sorry, not what happened, but what level of experience are you as a real estate investor? So for those watching on Zoom, I'm going to launch this poll right now, and we're going to take a second for each of you guys to answer the questions on there so we can get an idea of what level are you. Do you have 250 plus doors? Are you just starting out? Do you flip a ton of deals? And so we get a pulse so we can kind of cater our webinar to you as much as possible. If you're watching this live on Facebook, feel free to put into the comments what level of investor you are so that we can track that too. And it helps us get the feedback that we need. So while that's happening, while that poll is live, today, like Kathy, so you guys are all over the US, right? With what you guys do with Real Wealth Network. Have you heard any feedback? Do you guys deal with anybody that are trying to sell houses right now? Are they experiencing similar things that I'm experiencing where my houses are selling just fine? Or are you seeing other or hearing other aspects?
Yeah, we just had a meeting this morning looking at sales, and we've actually had a record month. So it's been really interesting, and it's not something I expected. I've been, as you probably know, if anybody's been listening to me, I've been concerned about some of the fundamentals out there with high debt, high corporate debt, high national debt, and then just so many, such as the entitlement belief in the U.S. that the government should pay for everything. So that, and then of course the Federal Reserve. So there were underlying issues that I've been concerned about for a while. So I thought, oh boy, this is it. And it's been very interesting. It could be like, Jay was saying that it's, Coyote's just kind of hanging there right now. But if you really look at the underlying factors of maybe why we're so busy right now across the board, every single market, when I've talked to the people that we work with, they're not seeing a slowdown because there's just seems to be a shift happening. And even with my own property, same thing. We put a property on the market, it's sold in a day, over 30,000 over asking price. So that to me says this is somebody who's desperate to have a home and to have their own home, and rates are low. And to Jay's point, like if you don't know how long this is going to take, you want a place where you can hunker down, and it's kind of the same thing with the Florida teams. I mean, again, this is today. Just what we're experiencing today is they cannot, these things sell faster than they can. I think our Jacksonville team just sold 10 last week.
Wow.
And a lot of that might be, again, people from New York saying, hey, I was always thinking about moving to Florida. Maybe now's the time and I could get those tax benefits. And so again, anything can change every day, but that's what we're seeing. And the same on the rental side, that yes, there are a group of people who will be affected, and there's a group of people that will be continuing to do business like we are. We're busier than ever right now, and we're not looking at any layoffs and so forth. So it's the beginning of it, but this is what we're seeing now.
So, okay, so let's get into the, first off, thank you, Kathy. Out of everybody that's here right now, it seems that like about a third of the people here they have at least a rental. And a third of the people that are watching this live on the webinar are just starting out, right? So those of you guys that are just starting out in this business, I'm sure you're really curious should you still be starting out in this business right now? And maybe we'll get into that here in this webinar as well. And then we do have a handful of people that have over 250 doors. There's one person or three people, maybe three people in here that are doing commercial real estate. So you guys are the minority in this group with that. But for the most part, it looks like everybody here is doing something in real estate, give or take, right? Which is great. So because there seems to be very heavy on the landlord side, let's switch over to the landlord portion of this and what's going on with that right now. So right now, from what we know of, right, tenants throughout most of the US our landlords are being told you cannot evict people right now. Is that pretty much what we're hearing throughout the whole US, or is that the whole US, or is that market specific? Do you guys think? Not think, but do you guys know?
Well, there's the federal, I should know what it's called, but if you have a Fannie or Freddie loan, I think it's, you can't evict for 120 days. Is that right?
That's right.
That's federal. Mm-hmm.
All right.
And then a lot of the states are having their own. So like we're in Arizona, so they have their own. And so states are coming out with some more specifics.
So with that said though, like if somebody misses rent, okay, great. You can't evict them, but can you not evict them ever? Or do we know the answer to that?
Well, I can chat a little bit about. So here's what we're finding is that the tenants, if they can't pay, they actually need something to be able to turn over to somebody to get rent assistance. So, so what the way it is here, at least, they have to come work with the landlord, and they have to have, like we have what's called a rental assistance request form that they come in and sit down, and we actually work out a payment plan with them. And then they can take that, for all the assistance that they're going to need. And so we actually have to move forward as if we're evicting them. And but what we can't do is evict them. So they actually need all that data, just like on a lender level. I was talking to Fannie and Freddie this week on the forbearance stuff that everybody's talking about, which is, bumping the mortgage payment down the road. You actually have to show that you were in a financial situation in order to get that. So it's kind of the same thing.
Okay. So it's just like you still have to go through the process. You just can't actually finish the process.
Right.
Right.
Yeah, we're kind of finding that too across the board with our property managers, that they're filing if the courthouses are open, and that's a big if. Not all are, but some are. And so just to get the filing started, you would be at the top of that list when you can eventually evict. Yeah.
Okay. So if that's the case, then if one of my tenants want to communicate with me, like, can I work with them on the rent payment? Can I do any kind of like deferment, or what options are you giving right now to your tenants if they're coming up to you? Are you saying pay it, or else you're going to get evicted later, or are you saying let's work together and figure something out?
So what I've told my property managers is that for me, from a negotiating standpoint, I want my tenants to pay something. More from a psychological standpoint than necessarily from a financial standpoint. Obviously, I want them to pay everything. I'd love them to pay as much as they can. But I would rather get $10 than zero, if for no other reason than it psychologically commits them to the idea of they are still paying rent. They haven't made that psychological shift to, I'm not paying, I'm going to wait, I'm going to take advantage of this as much as possible. And so for me, I have no stats on what we're going to collect this month. Again, I work to property managers, but I've basically instructed my property managers, just try and collect something if you can't get everything.
Okay.
Yeah, we have our Cleveland property manager produced a really cool letter through Keller Williams. Actually, her property management is with Keller Williams, and it was a letter. And again, I don't know if this is going to work. We don't know yet what's happening, but in the letter it said, we just want you to know that the person who owns this property, and these are 1 to 4 units, they're normal people too, and they're people who are struggling too with this issue. They might have lost their jobs. They care about you. They're asking about you, and they want you to know that they have all these bills they need to pay to take care of your property. They've got property taxes. They've got the mortgage. They've got all these bills, and they need, the rent is due. Basically, this goes towards that. And I think it was, again, we'll see if it works or not, but that was one thing. Another is just like, we do know that there's an enormous amount of money that's going to be handed out. So right now, people don't necessarily have that excuse that they can't pay. They're about to get a check from the government, so they can pay, right? At least that's the way we're treating it, is the rent is due. The government's helping you pay that.
Right. So as you know, Tarl, we have our own in-house management. And so we got a couple hundred folks in that company. And so what we're doing is similar to Jay. Well, number one, they have to come in and meet with us. They are financially obligated. So this eviction thing doesn't, relieve them from that. So they are in a lease. And so they're coming in. What we've decided to do is waive late fees and anything associated with that. And so if they come in, we're requiring at least 25% of rent, and maybe we can spread that over a 4-month period. And so that's what we're doing initially. And they have to do it all through this rental assistance request form. And so we'll see what kind of cash flow we have.
Well, let's hope it works.
Yeah.
Well,
we did it in 2008. I just want to point that out. We had a very similar situation. We called it a life interruption plan, and people came in, and there's going to be people that skip. There's going to be people that don't communicate. There's going to be people that pay, and there's going to be people that do communicate, and who knows what bucket everybody's in.
Oh, and Ken, I wanted to add one thing on that. Yeah, I mean, we're absolutely being flexible with the people who can't pay, but what the property managers are asking for is evidence. The letter that shows that they actually lost their job, or the letter that shows they didn't get a tax return, or they didn't get, there has to be evidence and proof. They just can't say that they're struggling.
Mm-hmm.
Right.
So one of the questions I was asked before this webinar from another person that registered for it, which is a good question, because we're actually in this right now. Like in the city of Tacoma, we have a number of rentals there, and we have a number of people whose leases are coming due, right? Or coming time for us to renew their leases one way or another. And the market rent right now, on some of these ones are lower than what the market rent is now, right? Sorry, the market, what we're charging for rent right now is lower than the market rent on some of these. And we had planned to increase the rent while it's coming due in the next 2 months when it's time. And Tacoma requires us to give notice 60 days in advance if that's to happen. Is it a bad idea or a good idea to start increasing rent right now, or even asking people to do that?
Not a good idea.
I would not be increasing rent right now. I have.
People are asking. So, yeah.
I mean, I think one cool thing incentive-wise that we're seeing, and it's actually working so far, is an incentive where if you pay 1 or 2 or 3 months in advance, you get staggered discounts on your rent. Yeah. So, if you pay May's rent now, you get a 5% discount or 10 or whatever. You pay June, some people are doing it.
Yeah. I think Tarl, I think the bigger picture for us is we actually just had a call yesterday with my whole management team, and we had in the last 10 days, 355 renewals. So we renewed 355 leases in the last 10 days at the existing rents, because we're trying, we think we're in a bit of a damage control. If they do move for, I don't know, $50, I think your vacancy loss that you're going to have for 1, 2, 3, 4 months later is going to be nothing compared to that $50 rent increase. So, if you can shore up, whoever you can, I think anybody that had a value add strategy in any way, whether it's a syndication or whatever it might be, is in trouble, could potentially be in trouble unless they have some real cash reserves. But in my opinion, we just checked, we have a little over 93% occupancy for our whole portfolio. And our goal is to keep that highly occupied and not go for any kind of rent growth, because $20, $30, $40, $50, $100 a month is a lot of money to a lot of people right now.
And you don't want to see that vacancy just drop from 93 to 80 to
right.
70,
right. What is that? 2 or 3 days of rent, maybe, right?
Yeah.
So,
and the conversation I plan to have with my property managers, to have with my tenants, is that I'm going to use this as an opportunity for those tenants that are having trouble paying and that can prove a hardship to potentially renegotiate their lease. Basically, say, hey, we'll work with you. Let's come up with some terms, but let's sign a new lease. So instead of them coming due this summer or August, maybe we extend it another 12 months. So we've now locked them in 12 months. So we're not in obviously the best situation if they're not paying timely, but if they have a history of paying timely, locking them in for another year is kind of the trade-off that can make it worth it for us. It can provide some benefit to us to go with that obvious downside.
Great. So right now we're going to do another quick poll. And this poll is to get a pulse from everybody here is, what are your thoughts on the market right now? Like, what do you think? Where do you think it's headed? So I'm asking all the attendees right now to answer this question. We're going to launch this poll. I want to get a pulse for you guys, a temperature, a thermometer, where you think things are going right now. And while that poll is up, we're going to also encourage you guys. There is a Q&A chat box here in the live Zoom that you guys can use, not the chat version, but the Q&A. And in that, you guys should be able to view the questions that are being asked from some of the users here, and you have the opportunity to vote up some of those questions so that's more likely for us to ask them. So ask your questions on the Q&A portion, on the Q&A box that you have on your little device there that you can do that with. And then also, if you see any questions that you want answered for sure, make sure you guys vote those up so that way we know what is happening on, what's most important. There you go. That's what I'm trying to get at. So we got, most of you guys have already voted so far. We'll take a few more seconds on that. To wrap up the landlord side before we get into all the other questions, let's talk about very briefly the short-term rental landlords that are out there. And I know there's a lot of people that were doing Airbnb before this happened. It was super popular and it's still popular right now. My wife and I actually just took advantage of some of the poor Airbnb people in a place not far from here and rented a really, really amazing house to sit out this pandemic for a little while and got it at a fraction of the price. But besides that, if you are predominantly owning Airbnbs right now, what do you do in this situation, right? Most of the cities have shut down Airbnb even in that scenario. Are you guys have any concept on that, or any advice for those people that are stuck with houses with no tenants in it?
Well, I don't know if you saw that article yesterday. There was an article in I think it was the Times. I don't know, like you guys, I'm reading everything I can. There's been a 45% increase in rental housing. Now this is London, and that's, they attribute it most of that to Airbnb, and they actually have it showing, they have, obviously the hotels are closed, and so short-term rentals are tough. And so people are trying to figure out how to rent longer term. And so those are coming into the rental market right now. It's going to be interesting to see. Obviously, tourist areas like Florida and California are going to, have a lot more than other areas. But I think if your strategy was based on short-term rentals, I think you're going to be in trouble because nobody's flying, and nobody's, that all the entire tourism sector is way, way, way down.
Yeah, I mean, I personally always saw that as a bit of a risk anyway, because Airbnb was, communities were fighting back against it anyway. So I was always telling people, if you're doing that, you need to have a backup plan because anything could happen. I certainly didn't expect this. But then I saw a similar article where, the Airbnbs that are in the woods, like way out far from everything, those are apparently booking out like crazy from people trying to get out of the cities. But then their license plates put them in jeopardy from the locals saying, get out of our town, we don't want your germs. So it's kind of a mixed bag, but I could see where hopefully the people who bought them can make the numbers work with a long-term rental as well.
Yeah, I'm in Florida, and I'm in Siesta Key, which is a very touristy area. So our governor has basically said no Airbnb for the next couple weeks.
Wow.
So people aren't allowed to rent. They're not allowed to move in. I don't know if or how they plan to enforce that, but they basically said no Airbnb. I have a feeling because values here for short-term rentals, basically in my county, there's county and a city. In the county, you can't have less than 7-day short-term rentals. In the city, you can. So it's very limited supply that's actually true short-term rental, like on the beach. Mm-hmm. And those investors are likely going to get hit really, really hard. They can't rent now. I know people that are losing literally tens of thousands of dollars a month on a duplex or a fourplex. And my guess is that we're going to see a lot of these formerly short-term housing properties that don't make sense as long-term housing, but I have a feeling that a lot of them are going to go back on the market and be sold at some point in the near future for prices that make more sense as long-term rental. Even if they're not used for that, I have a feeling it's going to reset the prices, at least here in my area. That
makes sense. So, all right. So the results of the poll for everybody that I'm sharing is that it seems like that some of you guys are on the fence. Many of you guys believe it's like almost a 50-50. Like people think that, hey, this is short-term, man. The future is bright. It's so bright I need sunglasses. And then there's the other 50%-ish that say the market's going to drop and it's going to continue to drop for some time. And only some of you guys are real pessimists that think that that we're all screwed no matter what. But that said, that's where we're all at. Some of us think that, hey, this is temporary. No, it's not temporary. And I'd love to get into that a little bit more. And we're going to get into that for sure. But in the meantime, right before we do that, I want to let you guys know that if you're watching this broadcast live, it is being brought to you by Fixated on Real Estate. You can go to our website, fixatedonrealestate.com. You can watch this webinar again and get the downloaded version of it should you be missing it or not be able to stick around for the whole time. It is free. You go on that website, no problem. You'll be able to get all the recordings of this, plus also all the other recordings of everything else we've done for free. Check it out after this webinar is finished. So outside of that, moving into you guys again for the rest of the show, we got some questions that are out there from the interwebs. One of the first questions, and we're just going to get, just so we could put a bow on this. Ken, you had said that during this time period that if you are doing a value add apartment of some sort, then you're not in a good position. Can you elaborate with that a bit more?
Sure. I think, first of all, it goes back to the question on whether rents are going to be up. You got to think of who the renters are. They're all the people that, are filing for unemployment right now. Not all of them, but, if you're in energy, hospitality, retail or any of these airlines, any of these sectors that are getting nailed, you're not going to be renting. I shouldn't say that. You will be renting, but you're not going to be renting to somebody at 200-300 more than what you bought it for. So if you bought anything, in my world, we did a lot of value add. So we would buy something for 20 million, and we would, the rent's, $150, $200. Everybody knows that model. So that model went on for a long, long, long time, and we all made a lot of money. And as I sold about $200 million worth of stuff in 2019 at like a 4 cap. And so, one of the things that I was telling everybody, I said, what I'm really afraid of is the exit cap rate. That's actually what I'm most afraid of, because if cap rates go from 4 to 5, that means that you have to have a 20% NOI growth just to cover it. And so, the exit cap rate is big when you're talking about commercial. And so if somebody has raised a bunch of money and has a value add strategy, and they're going out, especially depending on how their debt is, I think they're going to have flat rent, they're going to have higher vacancy, and depending on if they did short-term bridge loans or whatever their debt is, they could be potentially in some trouble depending on how much cash reserve they have. So that's what I mean by that. I mean, those will make each one's different based on the partnership and how it's capitalized.
Thank you, Ken. That question was asked by Elisa Zhang. We know Elisa. Good luck to you out there. And thank you for answering that. We're getting into some other questions. One of the things that I want to shift into, which is one of the questions that are up here, has to do with the lending market. And the lending market has shifted quite a bit. And Jay, you had said something when we were talking privately amongst the group about the concept of 2008 and how people out there, there's a lot of investors that I've met over the last couple of years that are like, I can't wait for the next downturn because I'm going to mop up the streets, right? So because you had made a comment, and I'm going to let you say the comment about our perception of going back in time of what 2008, 2009 was like, but what the reality of 2008, 2009 was. And maybe that concept for people thinking they're going to mop up the streets right now, what might be holding them back on that portion. Can you elaborate a little bit on that if you remember our conversation on that?
Yeah, absolutely. So kind of if I have to use another metaphor, it's kind of, if I ask people, last time you got really, really sick and you were in bed and you felt like absolute crap, think back to that time and think about how you felt. You can't do it. It's hard to relive pain. You have a memory, but you can't feel that pain. And I think there are a lot of people who lived through 2008 that are far enough removed from it that they can't really put themselves back into that emotional state. But more so than that, there are a whole lot of people that weren't really investing in 2008 or weren't paying attention in 2008, who you talk to them in 2016, 17, 18, and there's a lot of talk of, hey, we're getting close to a recession. And I talked to a lot of people over the last few years whose attitude has been, I'm really excited about the next downturn because it's going to be a great opportunity. And kind of the feeling I got from them is that they think that a downturn is going to feel exactly the way it felt the day they were saying those words to me, just like that day in 2018 where everything is great and everybody's happy and the world is just moving along happily. And they think of the next recession as being exactly like that, but real estate prices are half price. Everything's just been cut in half. And and I didn't explain that well, but basically the point is, in the midst of a recession, yeah, if real estate prices have dropped, and let's be clear, not every recession do real estate prices drop, and certainly they don't always drop significantly. So we can talk about that. But even in recessions where they do drop significantly, there are so many other correlated factors that make real estate investing difficult, and part of it's psychological. Part of it is, I remember during 2008 and 2009 where I was thinking, like, is this ever going to end? Are we ever going to get out of this? And had I known that 3-4 years later we were going to be where we were and the market was going to pick up, I probably would have done what Ken did and bought another 8,000 or 10,000 units. I wasn't that smart. And there are a lot of people who, when you're in it, just that psychological component of, is this going to get worse? Is this going to get worse? Even when it starts getting better, people start talking about, oh, is this a dead cat bounce? Is it going to get worse again? And people are scared to pull the trigger. And then from a more tactical standpoint, even if you can get around the psychological aspects of it, there's still the tactical aspects of it. So lending can be really, really difficult during a recession. People don't realize that. People are starting to realize that over the last few weeks, but the secondary market for loans has dried up. So it's really hard to find any kind of top tier lenders that are willing to lend. The conventional lenders, Fannie Mae, Freddie Mac, they're going to start tightening up, and you're going to find you're going to need a 720 credit score again, and you're going to need solid assets, and you're going to need solid employment and income. And then on the smaller side, on the private lending, everybody's talked for years about private lending and how great that is. But let me tell you something, a lot of your private lenders are going to get terrified, and they'd rather have their money sitting in a 401k than out in real estate.
Let's talk about that for a second. You brought up lending, which I'm happy you did. And because spot on, like into that, I remember when I got started in this business, like money was the hard deals were like, I'm tripping over deals, but I can't get anybody to pay for them. So there's no lending. And so it's that concept. And I remember tons of people that are like, oh yeah, I can't wait. Well, unfortunately, lending is going to be a bit of a challenge, just like it was, because it's usually never tons of deals and lots of money to give. It's usually one or the other. A lot of times. And you talked to me 30 days ago, I had tons of lending opportunities, tons of private capital, tons of everything, and no deals. Right now it's like the other way around, right? And so it happens fast. So let's talk about lending and what's happening in the capital markets right now. The fact, like Ken, you brought up something that happened to Fannie Mae not that long ago with the AAA bonds on a previous conversation you might have. Can you mention what that is and what that even means to the United States?
Sure. So like if we all get loans, they get packaged and sold off to investors. So that's how the market works. So if you've ever owned a home and you keep getting new mortgage statements, that's a result of, people buying those, and then they get rated. And so Fannie Mae went out to market with $1.5 billion worth of AAA loans, and there were zero bidders, which tells a lot about a lot. I mean, you think about that. First of all, it's Fannie Mae and AAA, which basically means that everybody's hunkering down with cash. And, and as I don't know if you saw, the government, the Fed just went out and bought a bunch of mortgages, and it messed with everybody's hedge. So these mortgage bankers, they hedge for price increases, and so now they have these big margin calls, which they're dealing with right now. If you just Google mortgage-backed security margin calls, you're going to see a ton of articles that just came up in the last few days, and so there's literally lenders that don't have the money, and they might go BK, and so we don't know yet. But I think Jay was spot on. Money is going to be really hard to get. And, even though we might be in a recession, it's super hard to get. Even though rates are at zero, they might be zero on a new truck, but they're not necessarily zero on a commercial office building where the lender might think that it's going to go to 50% occupied.
So on that point,
let me just say real quick, for anybody that just heard what Ken said and any of that kind of went over their head, I just posted an article in the chat box that kind of explains how the mortgage market works and why things today aren't necessarily as good as they may seem.
Yeah, and the lender of last resort is us. The Fed is buying. If there's no buyer, the Fed buys it, and they've basically made that sort of an unlimited thing right now. And there seems to be a belief that that can just keep going on and on. So that's where we don't really know how that's going to play out if the Federal Reserve can print the trillions and trillions and trillions of dollars for all these government handouts and bailouts of large companies as well who didn't make wise decisions. I could go on and on about my opinion on that, but I do want to say that in 2008, and you're so right, Jay, it's like there were deals everywhere, but everyone was bankrupt and foreclosed on, and their credit was shot, and no one had any money. They lost it in the market. So it was like, yeah, it'd be so great. I just sat there like, I want to buy stuff, but I didn't know how to syndicate then. But back then, That's actually why we started syndicating, was because so many banks had failed mid-project that, a great construction deal there's nothing wrong with it. It's just the bank failed and the construction loan disappeared and the builder couldn't finish it. And at the time, somehow through my podcast, an Australian group found us. They were not having the recession we had here in the US, and money flooded in, and we started doing syndications. What we had talked about kind of before this call was, is that going to be an option? Because this is really a global thing, right? So will there be foreign money coming in? I don't know, but that is going to be the issue, is where's the money going to come from to acquire good deals if you do see them, and can you syndicate, and will there be syndication money?
Well, on a short point, for what you do, Kathy, and because you syndicate deals, like you're part of many deals, and you raise capital for many deals. Right now, are you still in that process right now, where are you still syndicating any deals right now? Or are you guys holding off, or what's happening?
Yeah, I mean, due to SEC law, I can't talk too much about it, but we are. It's a low LTV, it's a loan deal, so that's all I can say. Oh, you know what? It's sold out anyway, so I guess I could talk about it. I'm not selling anything.
Specifics, but you're saying like, yeah, you just raised some capital and stuff. But
yeah. Believe me, we're looking at it carefully, and then my partner is 72 years old, and he's been through many downturns. Never like this one. This is unique. Every downturn has its uniqueness to it, and I think all of us. There's a lot of people listening who now you get to have the proud honor of being able to say you've been through a downturn, and what's most important. Yeah. So what's most important, in my opinion, is this is a time for creativity. It's awesome. Like back then we weren't doing Zoom calls. Like there was I was trying to figure it out on my own. I didn't know who to call or what to do. So it's like now you have more resources, but it's going to be super important to be creative, to be able to turn your ship quickly. And that's why, turnkey property, it didn't exist before the last downturn. That wasn't a thing. We were helping investors buy brand new homes, because foreclosed homes was not a thing in 2006. All of a sudden in 2009 it was, and there were no new homes. So we had to figure out, well, how do we buy these foreclosures, fix them up, get them tenanted so that, all these Australians who wanted them could get them. So we had to create this thing called turnkey. And there may be something new that gets created from this that we don't know yet.
Maybe there's an opportunity somewhere.
Yep.
Right? And then,
I'll tell you, I think it's going to be interesting when we talk about syndications these days. Most of us, and obviously not all of us, Kathy, most of us think multifamily. That's the kind of the prototypical, that's what you use syndications for. And we've gotten so accustomed to syndications or multifamily. Syndications are, you're providing investors 15, 16, 17% IRR, 8% preferred return, blah, 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 blah. I think what this is going to do is it's going to reset the expectations for a lot of investors who have this cash to put out there. And they start to realize, I'm not going to necessarily, maybe there are things other than multifamily that can be syndicated. I'm not necessarily going to get 16% IRR. I might not necessarily get a pref. And I think a lot of creative investors, again, people like you, Kathy, are going to realize that there's opportunities for these models that we've kind of been doing the same thing year after year after year for the last decade or 2 decades or however long. But there are ways to play around with these models and with these numbers and create new models and create new things. And I'm actually interested in seeing in a couple of years, what's the big thing going to be? Is it going to be turnkey? It's not going to be turnkey. It's not going to be multifamily. It's going to be something else that's kind of popular and whatever. And it's probably going to come from the pain points that investors are going to experience during whatever the next phase of the economic cycle is.
So if I'm a new investor right now and I have this really sweet deal, what do I do? Do I buy it right now or do I wait?
What kind of deal?
Depends on the deal.
Yeah. Is it really a sweet deal?
That's always the answer, right? It depends. Right? What's the deal, right? So I'll be honest, I'm buying a house next week, right? But it is a super sweet deal. But we know our numbers and we know what we're buying. But that said, though, even if no matter who you are right now, one of the questions that's asked by Fern is their hard money lender has informed her that their lending has been suspended until further notice. So have you experienced this so far? So what do they do? what happens now, right? To hard money. And if you don't know hard money, those are the loan sharks of the industry. They lend at higher rates, but on properties that aren't going to be able to lend it out on conventional and sort of stuff. So your short-term loans, 6 months, 12 months, that kind of thing. But
I'll tell you what I would do is, I mean, there's a lot of people really scared, don't know where to put their money. Go find private lenders who would just like any kind of return at this point that's secured to real estate at a really low LTV, but you're not going to be getting high LTV and you shouldn't. But if it's low, I would think there would be some people that would feel safer there than maybe other places.
Yeah, and I would just add, I think Kathy and Jay are great examples. And so all four of us are of, bypassing that, bypassing those hard money lenders and going directly. There's a lot of wealth in looking for places to invest. And if the deal is really, truly a sweet deal, it will get funded. That is the truth. And but it's going to be harder now because there are less of those people. But my experience has been that, if people with a lot of wealth are still looking, nobody wants to have their money sitting in the bank at, making less than 1% and then potentially super high inflation. One of the things that I would be looking at is inflation and what it's going to do to our dollar, and so one of the things that we did in 2008 is we went up to Canada and we raised a little over 100 million. And because their dollar was equal to ours at the time. And then what happened was, as our dollar got stronger, the money we were giving back to them, there was actually a nice hedge on the currency back to them. They made almost 40% on their currency. And I know that, so some people might have to wrap their head around that, but the truth is money's money. And so as we start to do things with our dollar, for example, you should start to take a look at. That's why when things started going bad in China and Russia and Europe, they started, we were the cleanest dirty shirt, in the nation, I mean, so everybody was putting their money into the US. Well, that might be different now. So I just want, it's a global thing. Education is everything. And there's a lot of money out there.
Yeah, that's it. That is definitely highbrow, but that is definitely golden nuggets. Big time, what you just said, Ken. And if you guys are watching this and you didn't get it, watch the replay later and hear what Ken just said 4, 5, 6, 10, 20 more times. So it's very, very important. On that note as well, so this is kind of a double question, like combining from two different people, Annie and Ivan. Basically summarizing their questions is, if I got a bunch of money in the bank right now sitting in cash, what do I do with it?
Don't keep it in the same bank.
I would ask them, what are you an expert at? Not necessarily that's something that you should be doing, but that's the first question you want to ask, because that's going to limit your choices. And then from that subset, what are you really good at? Once you narrow it down to that subset, then you can ask within that subset, what makes sense. So I think of real estate as falling into, or most investing is falling into one of two categories. It's either transactional, you're buying low and selling high, or it's cash flow. You're buying something and it's generating income for you. Now, obviously there are some other things, but that's most of them. And then some actually fall into kind of the middle, like value add apartments, where you're kind of doing a little bit of both. But each of those models is going to work differently in times of economic turmoil. So if you're in the transactional, what you're considering as transactional, buying low and selling high, like flipping houses or wholesaling, that's going to be different. That's going to be difficult because that relies on you being able to determine an accurate value for the property at the time of resale. And right now, we don't know where prices are going. We don't know if 3 months down the road, ARVs are going to be exactly where they are today, if they're going to be 30% less or 10% higher. And so without knowing what future values likely hold, any type of transactional investing model is going to be highly risky. Now, you look at the cash flow models like buy and hold or notes or just making loans, whatever it is, those tend to work in any times of any part of the economic cycle. Those are going to work because basically you're underwriting cash flow based on not necessarily the value of the asset, but how much that asset can generate in cash flow. And you can run the numbers that basically say, hey, I don't care if the asset value goes to zero, as long as it's generating an amount of cash flow that supports whatever the debt service and my profit and expenses are. So these days, in general, I'm a much bigger fan of buying something that's going to cash flow if you really feel like you need to use that money than doing something transactional with it, like flipping or whatever. So go find a rental property, go find make a loan, a safe loan. And we can talk about what types of loans these days tend to be more safe. Go buy a very low loan to value note. So a highly discounted note, those sorts of things that'll generate cash flow. And you don't care what happens in 6 months to the value of the underlying asset.
Excellent. So do you guys think that we didn't really specifically go into this too much, and I want to jump on this question because we're going to be wrapping up here soon. And there's a lot of questions from you guys that are on the Q&A. And we are going to, this is recorded, so if you missed some of this, you guys can rewatch this. You should get an email invite later, but also you can join us at fixatedonrealestate.com and become a free member there to get the recording of this as well. But that said, we talked about like is this going to be a nationwide real estate situation, or is it going to be, or separate markets going to be more impacted than others? And what do you think would be the what do you think would cause one market doing fine and another market maybe being hurt or whatever it might be, as far as like, is it unemployment ratios? Is it, demographics of that area? Is it white collar versus blue collar jobs for different marketplaces? Which areas do you guys see getting potentially hit the hardest from what's happening right now?
I mean,
Well,
we know.
Oh, I'm sorry. Go ahead, Kathy.
Yeah, no, you go.
Well, I was just going to say the answer is yes, Tarl. No, just kidding.
Should we be laughing at that?
well, I think Kathy said it perfectly in the beginning. This is not a nation real estate. There's hundreds of markets. You know what I mean? So when people quote, we're 94% occupied in the nation, that doesn't necessarily mean that every city is, or rent growth or home appreciation growth. So I think it's really important to see that. But I think you got to go to the industries that are getting nailed first. So like energy, for example.
Yep.
Obviously, Houston, Texas is going to get nailed. If you want to go to the lodging and airlines, Florida is going to get nailed. Southern California is going to get nailed. So, you have to, I think, really pay attention to those things. It was encouraging to hear Kathy talk about, the Cleveland Clinic is massive in Ohio, and Ohio's really known for healthcare, as an example. I think you're probably going to be okay, a little bit better than some of the other markets. So, every market's going to be very, very, very different.
Yeah, and one thing that was super fascinating about that Cleveland property management webinar that we just did yesterday is Ohio, very surprisingly, was one of the first to just do the shelter in place and shut down businesses. That's not typical for Ohio to be on the leading edge of, things like that. So, that may be another reason that, because it's a medical city, they were like, hey, contain it. They were one of the first to work on finding, on creating testing. And so they got it quick. They worked on containing it, and they may not see some of the other issues that gateway cities like New York are going to see. Or here, I'm sitting here in LA, kind of freaking out because we're a gateway city and we're a hotspot. So, but of course we don't invest here. So, Seattle's going to have its own share. The cities where people are living closer together may experience more issues with the virus, and therefore potentially other economic issues. And any cities that were just bubbly, there are certain cities, again, like New York and San Francisco. And I've had Harry Dent on the Real Wealth Show a few times, and man, is he negative and scary, but he's been saying this for years. Like, New York and San Francisco were overpriced. They're more invested in the stock market. There were not, some people say there were fundamentals in the stock market. I didn't think so. And so he felt that there'd be something that would prick that would slow it down, just like it always happens. When things get too high, they come back down. And that the big cities where most people invest in the stock market would feel it because they're already overpriced anyway. But then the Clevelands, where you can buy a beautiful home in a beautiful B class or A class neighborhood for $150,000 and have a doctor rent from you, different story, right?
Good point. Yeah.
I think a lot of what's going to drive what we see in the economy over the next 6 to 12 months is the reabsorption of all these jobs that we've lost. So I think it's safe to say that next month we could see 30% unemployment, 40% unemployment. But it's also safe to say that once this crisis is over, we're not going to see 30% unemployment. Most of those people are going to go back to their jobs. If you're a teacher, you're going to go back to your job. If you're an engineer, you're probably going to go back to your job. Most of these people are going to go back to their jobs. But there's going to be a certain segment of the economy where people aren't necessarily going back to their jobs because those jobs may not exist anymore. So I had the owner of the #1 bar in the country on my podcast last week, and he was talking about the fact that in the restaurant industry, they're talking about 75, potentially up to 75% of all independent restaurants could go out of business and never reopen. Wow. I mean, that is just a ridiculous number. And hopefully it's not that high, but even if it's 20%, even if it's 25%, that's a lot of people in that industry that aren't going to recover quickly. It's going to take some amount of time for their jobs to be reabsorbed. And if there's not as much demand, if people aren't spending money, if companies aren't spending as much money, it's going to take even longer for those jobs to be reabsorbed because the economy is not growing. Then you have areas like where I live, where it's heavily dependent on tourism. I mean, I can promise you that most people in Orlando, Florida, I'm a couple hours from Orlando, that most of those people are not going to be getting their jobs back. Not most, I'm sorry. There are going to be at least some people at Disney who aren't going to be getting their jobs back because there's not going to be as much demand at Disney. And certainly all the tourism around Disney, the shops and the restaurants, they're not going to see as much. And so I think in areas where we're going to see this reabsorption of jobs a lot less than in other areas, like we talk about Silicon Valley and San Francisco as being one of those areas that's really overinflated. But let me tell you something. People at Google are going to go back to a job in a few months. They're probably not going to lose their jobs. People at Microsoft are going back to their job. People at all these companies are going back to their jobs. But in areas where it's heavily reliant on tourism, it's heavily reliant on restaurant business, which I guess is part of tourism. These places, you're not going to see as quick reabsorption of those jobs. And those are the places that I think are going to tend to get hit harder.
Well, it's just like in 2009, 10, 11, 12, 13, 14, Florida was just like not doing so hot.
Florida, Las Vegas.
And it took a long time
Vegas,
for those markets to finally get where they were a few weeks ago, and continue to be that way. And so it's a great point on all that, and it seems to be extremely volatile in those areas right now. But especially with the Airbnbs and on top of the restaurants, everything you just said in the tourist area. On a side note, I would suggest if you guys are planning on any vacations after this is all done, now's the time to go start shopping around and buying those. Because I bet you can get some really world-class resorts for like free right now because they'll make food and
they'll probably pay you to take a cruise.
I'm not even kidding you. Like, now's the time to shop. Don't be scared of that, right? So put it on a credit card. No, joking. So here's one of the final questions. We have like maybe 2 or 3 more questions we're going to ask, and then we're going to wrap up. But most of what we're kind of saying right now is like, who knows what's going to happen? But in reality, like if we were sitting right now, like we're all in real estate, and we had any kind of advice to give to where, hey, here's where I would go to make money in real estate right now. This is kind of a question Kyle asked. Where is there even a way to make money in real estate right now that we could maybe possibly be doing, or do you guys have any thoughts on that? Like, what can we do right now to make money?
I mean,
you have
you go.
You first, Kat.
I think you have to focus on who's spending money. You know, like what industries are doing well now. And, you know, back to the Cleveland example, you know, that's where, if I had any advice, what I've been telling everybody is to hold on to cash and just give this 90 to 120 days and just watch and just see what unravels.
Yeah. If you're sitting on cash, just don't have it all in one bank. Just spread it out. I did a Google search of safest banks, and US Bank came to the top, and there were some others. So just, look at that. Only have spread your money out. Have some in gold. Have some. Try to get cash. That's harder to do right now. But yeah, if you're just sitting on cash, there's some opportunity. Now, I also think, this is my personal opinion, that our president is going to throw everything at this to get reelected. And so I kind of think we have a little time. I don't think we're going to see the floor fall out right now. They're going to really literally throw everything at it. And so if you're trying to reposition things, or like I said, we just put a property up, sold it immediately. And I'm going to sit for a little while, cash out with that. But we also have a bunch of people who are still selling their high-priced assets because places like San Francisco, you know, real estate's somewhat slow moving, right? So you have a little bit of time, at least I think until the election, to reposition things. So we are seeing a lot of 1031s where people are selling their high-priced assets while they still can, and buying in, you know, kind of like if they could sell one and buy 10 elsewhere. So that's my message: is you have a little bit of time. Don't panic. Don't panic.
No reaction, right? Don't react. Jay, do you have any thoughts?
Cash flow works in any part of the economic cycle. So obviously change your underwriting around a little bit. So if you look at 2008, which is kind of prototypical worst case scenario, not saying it can't be worse, obviously at some point it has been and it will be, but for the most part, 2008 is probably reasonable to assume as a worst case scenario. In most markets in 2008, C-class property market rents didn't drop too much, a few percent. In a bunch of areas, it actually stayed flat or even went up in a little bit. So if you're underwriting buy and hold deal right now, underwrite to 10% lower market rents, underwrite to 10% higher vacancy, and focus on kind of the C-class, working class housing. And if you do that and the numbers still pencil out, buy the deal. Because again, especially if you're playing for a long-term hold, it doesn't matter if the asset value, it doesn't matter if the house goes to $5,000 next month, as long as it's generating the income, as long as it's generating the cash flow. Focus on areas, 3 things I like to look at: population growth, employment growth, and wage growth. So focus on areas that have a diverse employment, that have decent sized wage growth over the last few years, that are forecasting population growth, that are forecasting employment growth. Even if we don't see that, those areas are probably better primed than those that aren't forecasting that. And just stick with cash flow. Something else I'm doing, which is not going to be, it's not going to work for a lot of people, but I like buying businesses. I'm focusing on buying businesses that the business owner.
They're on sale.
Wow.
Well, and specifically where the business owner owns the land underneath the business.
Wow.
And so you can pick up some great deals. I actually, we talk about this on the podcast. It's either going to be next week or the week after. But you can pick up some great deals where essentially SBA can finance the business. The owner's in a lot of cases willing to finance the underlying land, and you can buy a business with land for really cheap. And then at some point, if you want, you sell off the business, you keep the land, and now you have a built-in tenant that you know he's going to pay because you've sold him the business. And if you hold a note on part of the business, you can ensure he pays or you take the business back. So, I mean, more complex strategy. You have to actually want to be an entrepreneur outside of real estate, but it just goes to prove that if you're willing to be creative, if you're willing to work hard, there are opportunities out there now let me just say this one thing. Okay. A lot of us look back to 2008 and we think, damn, I wish I would have whatever that is back in 2008. I wish I would have 1,000 properties. I wish I would have bought apartments. I wish I would have. And they think I missed the boat. I missed my chance. Well, let me tell you something. I don't know if this is going to be an opportunity for that again, but it might be. Don't be in a position 5, 6, 10 years from now that you look back and say, I wish I would have. Get prepared now so that in a few years you can look back and say, I'm glad I did.
Yeah, take this time where you're quarantined and learn and study and get great, become an expert.
And it has some great books. Go read them right now. By the time the deals appear, you'll be ready for them.
Love that. And so I know that from some of the advice I got, one of my buddies, Shane McGraw, with him and I were talking before this, and I liked his take on things, which is something that we've been doing, is that instead of looking at like how many more houses can I acquire right now, why not take a time, maybe once a week, maybe a couple hours a week, to say, how can I optimize what I have currently already right now? And either can I cut cost 5% here? Can I maximize something here, and like work on the business that you have to get your effectiveness and your efficiency way better on your current business with what you got, and take the time to reevaluate and respeculate what you currently have as much as possible, so that you can be primed in a stronger foundation for later when the opportunities possibly come out. And only take a few, even if it's just a few hours a week. Some people might be forced to have to do that right now based off of some fires they might be having. But take a step back. Like, that's my advice. Take a step back for a second. See what you have. Where are your cards out? Maybe you've been rushing headlong at 100 miles an hour and not even like paying attention to where you're going. Well, now's the time to slow down and realize where you are. or maybe you've been trotting along just fine, but smell the roses, figure out what's up, set your game plan, cut some costs in places. Think the whole is more important than the parts at times. So sometimes you might have to cut a few expenses, and that might be, some people that you don't want to cut, but you got to think long-term through this to get through the scenario so that the whole could continue to go forward. And that's your business and that's your family, right?
And Tarl, you're always preaching systems and processes. This is a great opportunity for people to work on improving their systems and processes so that when they get back to business, they're ready for it.
So last question for everybody. Oh, Ken, you got something? Sorry.
Well, I was just going to say, I just did a financial stress test video that we put out on YouTube.
Perfect.
For personal, business, and properties, that go through all the different operating expenses and all the things that you should be looking at. Because we just went through that as a property management company. We looked at every single operating expense, and we started renegotiating insurance and property taxes and conservation on utilities and all the things that we had and could, negotiate. And so I just put that into a video.
Love it. Where can they get that video?
It's on YouTube under Ken McElroy, Financial Stress Test.
The Ken McElroy. So what we're going to ask the last question. Before we get to that last question, a lot of you guys asked a lot of questions that we did not get to. After this is all over, I'm going to go through all that stuff. We're going to analyze that as a business internally on our side. And we're going to do our best over the next number of weeks to produce webinars for you guys like this, if you want it, that will help answer these questions that are on your guys' minds, to be able to continue this feedback as much as possible, get more guests out there if you want that. So at the end of this webinar, there is a survey that'll come up automatically. Ask the survey. If enough of you guys want us to keep doing this, we'll keep doing it. If not, well then, hope you enjoyed the only one. So that's it. So last question, as we're wrapping up, 6 months from now, where are we? What's going on in the world? What's your thoughts? What's happening? Kathy.
Oh, one time I'm speechless. No, that, if the election doesn't get postponed, like I said, we're already talking about a fourth QE. We're talking trillions of dollars. We've already spent more. The Fed has already created more money just in the last month than they did in, trying to save us from the Great Recession. And they're talking about another round, and it's unlimited. They are going to throw everything at this. And generally speaking, in the past, when this much money has been thrown into the money supply, I don't even know if they could put it on a chart right now. It's like, whoop. Generally speaking, that is to lift asset values. Right now, there's the fear that they'll drop, right? So this is an attempt to keep things floating. And that's what we've seen in the past. Now, in the far future, there are ramifications for that. But in the near future, it is an attempt to hold things together for probably most likely for the election and for America. So in my opinion, if those who don't own assets of some kind, I don't know. I just do believe in hard assets, especially in the affordable range in areas where there are manufacturing jobs. And that's been, I think if there's one thing we've learned, a huge lesson we've learned from all of this is the US does need to be manufacturing. We can't depend on our life needing medical supplies and medicines to be imported. So any areas that have typically been manufacturing places will probably do pretty well, because I think a lot of that will be coming home. So.
Jay, 6 months, go.
So if you would have asked me a week ago, it would have been, I would have been a lot more optimistic. Kathy is one of the smartest people I know, and I 100% agree with her that this administration is going to throw absolutely everything they can at this. My concern, though, is throwing $5 or $10 trillion at this. What's it going to break? And we've already seen some ramifications in the mortgage market with basically the government throwing lots of money at MBS, mortgage-backed securities and bonds, and it's sort of broken the mortgage market, and it's causing a lot of secondary lenders to basically be put in a position where they're getting what's called margin calls, and lots of things are breaking because we're throwing so much money into the system, and we're doing a lot of unprecedented things. So my big concern is not that the government's not going to try and do enough. It's that what they do is going to break things in ways that we can't even forecast. And I predict, and I don't mean to be doom and gloom. I mean, we're going to recover. This isn't the end of this country. It's not the end of the world. But I do think that this is going to be more than a 6-month or even a 12-month issue. And I think we're going to see, I think this is going to be the next, we're not going to jump back into an expansion right after this. I think this is going to be a recession.
Ken.
Well, I think that the government's going to try to prevent a depression, which is just a longer, very long recession. So I do think that, and I agree with Jay and Kathy. There's a couple things, if you just look at last week, we had over 3 million people file for unemployment. So we're looking at 8 to 10 million probably over the next, 60 days, I would guess. Those are real people that usually spend and consume. And so I think we have a massive consumption issue this whole year. I don't think people are going to travel like they did. I don't think they're going to, spend money like they did. And I think there's going to be a lot of things that are changed. But that's going to create massive inflation at some point. And so that's going to be the big question is, what does that mean? But I don't think that you can more than double the money supply and keep the dollar strong. I just don't see how. I don't see how you can do that. And so they seem to be able to mask that a little bit during the bank bailouts. But, we have to have some rapid inflation at some point. But I don't think that's going to show up this year. So if I was what I'm looking at right now is what happens, like Japan went through this and some other countries went through this. What happens when you flood the economy with QE? And stimulus, because that money is going to show up in stimulus, it's going to show up in unemployment, and it's going to, all those things. And so what's going to happen, because things will get worth less. And so oddly enough, being in debt is going to be good, because low cost debt, because if you can borrow cheaply and you're going to be paying it off with cheaper dollars later as the dollar value declines. As things start to come out, I believe you should finance them over the long haul.
So it's like, okay, correct me if I'm wrong, but what you just said is that you're locking in somebody else's money, and then inflation is basically eating their money away that they locked in at a low interest. So if they're lending at 2 or 3%, but inflation's 4, 5, 6%, then you're paying off.
Then you're making money on other people's money. Right. Exactly right. Yeah. So if you can borrow less than inflation, essentially.
Yeah. I mean, here's the way to think about it in real numbers. Imagine you borrow $200,000 and you're making $50,000 a year, and you borrow $200,000. Let's say we then have massive inflation and everything goes up 5 times in price. So milk is now $10 a gallon, or $10 a gallon, and oil is $10 a gallon, and whatever. Well, wages tend to go up with that. So instead of making $50,000, you're now making $250,000. The dollars don't go as far, but you're making $250,000. You borrowed money. You borrowed $200,000 when you were making $50,000 a year, basically 4 years of salary. Now you're making $250,000 a year, but you still only owe $200,000. So you can pay it off with 4/5 of a year in salary. So basically locking in, you're paying that off. You're paying off that loan with cheaper dollars.
Fantastic. So
thank you, Jay.
Yeah, Jay's the educator, just like you can.
He is. It's great. I was like,
he educates for bigger pockets, which he loves. So he's used to talking to people that are just starting.
I get asked these questions so many times that I eventually figure out a way to say it that makes sense.
Yeah, that was super helpful.
Not that my opinion matters, but ultimately, my last thoughts on this is that, like, if the Fed continues to dump as much as they're dumping, if unemployment is continuing to skyrocket as what is going, if we can't leave our freaking houses, I'm not worried as much in 6 months from now about my rentals. Right? I'm worried about a lot of other things like that are going on in the world and the economy, personally, right? So let's hope that's not the case and whatnot. But that said, I also don't care. So it's the The reason why I say that is that I know I'm personally not going to be able to do anything about it other than handle what I have in my business, in my life, in my family. And we're going to have to do whatever we have to do to take care of, our business, our family, and the people we care about. So, and I know I'm not going to change the Fed's mind. I'm not going to change the world economy or anything like that personally, but I could change my family, and I could change my friends, and I could help out people as much as I can one way or another through that. And I'm going to deal with what is, not with what isn't. So there's just nothing I can do about it. So I'm just going to stack my chips, figure some stuff out, and see what happens, and hope that the rest of the world doesn't fall apart. So that's my mentality, at least. And so maybe I'll just go snowboarding. I don't know, but if that's even allowed. Actually, that's not even allowed right now, right? Yeah, we're outside. Why can't we snowboard? Okay.
Surfing is still allowed.
Yeah, surfing's still allowed, right? Okay, sure for now. All right, enough about that. So guys, I really loved having you on this. For those of you guys that are still tuning in, you guys can catch the entire recording on our website, fixatedonrealestate.com. You should get a survey question and also a link to that later. If you want future ones, make sure you guys mention that on our website, so that way we can get to you guys that information as we go out. We will review all the questions that you guys had already asked and potentially make more content for you as we go. Maybe we'll have these lovely people on every other week. I don't know. I haven't asked them yet. No, I'm joking. But thank you guys. Any last thoughts? Ken, where can they reach you?
KenMcElroy.com is the best spot. And, we have a number of things there to educate. We actually just posted the rental assistance request form on our website for anybody that might need that to work with tenants. So that's the best spot.
Awesome. Kathy?
realwealthnetwork.com and The Real Wealth Show.
Fantastic. And Mr. J?
So website, jscott.com. Follow me on the Bigger Pockets Business Podcast, not that cheesy Brandon and David podcast, the Bigger Pockets Business Podcast. And I write a lot about economy and economic stuff on Facebook. So feel free to follow me on Facebook at jscottinvestor.
Yep, I actually get all my news from Jay's Facebook because I don't watch any other news. So and on top of that, for me, you can follow me on Instagram at Tarl Yarber. I am the only one. And check out our website, fixatedonrealestate.com, just for this stuff. We're still making it prettier, but it has a whole bunch of content on it for free. So
I'm going to name I'm naming my next child Tarl Yarber. Just so you won't be able to say any longer I'm the only one.
That's not legally available. So you just do it. Actually, so we're my wife's pregnant. We're having a son.
Yay!
And
congratulations.
Thank you. And I've been asked multiple times, like, you gonna name him Tarl Jr.? I'm like, hell no, that's my name. He doesn't get my name. Right, I'm the only Tarl. That's not true. I'm not the only Tarl, but there are other Tarls out there, believe it or not, which is weird. Such one. Okay, enough about me. Let's talk about you guys. So, love you guys to death. Thanks for being here, and we'll see you guys on the next one, or maybe not you guys, but the attendees of this beautiful event. And we'll talk to you guys soon.
Thanks.
Good luck, everybody.
Good luck, everybody.
Bye.
Thanks.